Hmm. Hello, everyone. Thank you very much for joining us once again today. Welcome back. This is our 13th webinar on the UE corporate tax, and we are discussing today deductible expenses. Hello, everyone. Thank you very much for joining us. So businesses can claim which expenses businesses can claim while preparing the corporate tax return, and which expenses businesses cannot claim while preparing the corporate tax return. We all know this, that the taxable persons are liable to submit the return on annual basis. And we all know this, it has been given in the law as well, that the taxable person will adjust their accounting profits. They will adopt indirect method to calculate the taxable profit. They will adjust their accounting profit, and after making the adjustment, they will arrive at the taxable profits. So what type of adjustment will be there related to the expenses specifically, we will discuss in this webinar. So whatever we have discussed till now, we have discussed overview of the UE corporate tax law. We have discussed resident and non-resident taxable persons. We have discussed exempt persons. We have discussed out of the scope persons. We have discussed UE sourced income, permanent establishment and its history, corporate tax registrations, application of corporate tax on the partnership, application of corporate tax on the free zones, application of corporate tax on the family foundations and trust, how to compute taxable income, unrealized gain and losses on assets and liabilities, that whatever we have discussed till now. So overall, if you see, we have discussed the scope of the corporate tax till now. Now, today we are discussing deductible expenses. So this is a general rule for the deductibility of the expenses. Is this general rule can be classified into three categories. Some expenses you can claim 100% allowed expenses if these expenses are wholly and exclusively for business purposes. Then we will discuss this in detail. Some expenses you cannot claim at all. These expenses will not be allowed to arrive at the taxable profits. Some expenses you can claim proportionately, means there is a place, this place is used for business purposes and non-business purposes. If this is non-business purpose and business purposes, whatever the portion is being used for business purposes, we will be able to claim this, that we'll discuss in detail. So we'll say on overall basis, the general principles are some expenses can be claimed 100%, some expenses cannot be claimed at all, some expenses can be claimed on proportionate basis. And this has been covered in the Article 28 of the UE corporate tax law. The subclause 1 of the Article 28 of the UE CT law says expenditures incurred exclusively and wholly for business purposes. This is not capital in nature. This word is very important. That is not capital in nature. So if expenses are wholly and exclusively for business purposes, these are not capital in nature. The law says it will be deductible in the tax period in which these are incurred, subject to the provisions of the degree law. So first thing established, these expenses will be 100% allowed, subject to the condition these expenses are wholly and exclusively for business purposes. These are not capital in nature. We'll discuss what is capital and what are the revenue types of expenses in the same webinar today. This is the first category, means these expenses you can claim 100%. The second category is you cannot claim these expenses 0%. You are not allowed to claim these expenses to calculate taxable income for the tax period. No deduction is allowed for the following. First, expenditure not incurred in the purpose of business. If you are not incurring expenses for business purposes, you don't have any right to claim these expenses. Expenditure incurred in derived exempt income. If the income is exempt, apple to apple comparison, if you are not paying any corporate tax on the income, definitely all related expenses related to that exempt income, you cannot claim those expenses as well. Losses not connected or arising out of the taxable person's business means the other business loss cannot be adjusted against another business law. This is very straightforward apple to apple comparison. Such other expenditure as may be specified in the decision issued with the cabinet at the suggestion of the minister. It is provision article subclause 2 of the article 28. So clause 1 says you can claim 100% expenses which are revenue in nature, wholly and exclusively for business purposes. Clause 2 said you cannot claim expenses if these expenses are not related to the business. If these expenses related to the exempt income, losses pertains to the other business cannot be adjusted against the other business profits. So such other expenditures as may be mentioned in the cabinet decision issued at the suggestion of the minister. Third category is we discuss proportionate category. These expenses, first of all, we need to look into this, the common expenses. These are the common expenses. Out of these common expenses, before we need to identify some portion of those expenses wholly and exclusively pertains to the business. If we can identify those 100% expenses, these we can identify these are the direct expenses and pertains to the business, then we will claim 100%. If we are not able to identify these are the common expenses, these common expenses will be claimable on proportionate basis. Often identifiable, unidentifiable, or proportionate of the expenditure incurred for the purpose of driving taxable income that has been determined on a fair and reasonable basis. I believe this fair and reasonable basis will be given in the corporate tax regulations. What will be the basis to allocate the expenses? It can be, might be different basis, might be taxable supply, might be area, might be units. They will give some sort of basis in the corporate tax regulations. So common expenditure will be allocated in between taxable person and not and any other person on reasonable and fair basis, and these expenses will be claimable unproportionately. So we have these will be partially allowed. So three things are very clear as we discussed. Some expenses are allowed 100% wholly and exclusively for business purposes, which are not capital expenses in nature. Second, you cannot claim expenses which pertains to the business, which related to the exempt income, or losses of other business cannot be adjusted against the profits of other business. And any other expenses which are common expenses, it will be claimable on proportionate basis and reasonable and fair basis. So the expenses, whatever we have discussed, these are whatever we have discussed now, these were the general rules. General rules can be categorized in three categories we will discuss in detail. Now these are the type of expenses. These expenses can be revenue expenses or it can be capital expenses. We have discussed in the first 28(1), article 28(1) of the UACT law. We have discussed wholly and exclusively for business purposes which are not capital in nature, means expenses, revenue expenses or capital expenses. In total, these are the total expenses. Whatever we can claim 100% in the same tax period in which expenses are incurred, we can claim 100%. These expenses can be salaries, wages, courier charges, day-to-day rent. In the same marketing expenses, these are the revenue expenses. So if we're looking at the definition of revenue expenses, the revenue expenses are incurred for the day-to-day operations of the business. Day-to-day operations of the business. It doesn't add any value to the assets or reduced liability. These are basically expenses which are expensed out in the same tax period. For example, courier charges, for example, salaries, sales and marketing expenses, postage, repair and maintenance, all these expenses are revenue in nature. And all revenue expenses can be claimed in the same tax period in which these expenses are incurred. This is what we have discussed in the article 28(1) of the UACT law. Now there are capital expenditures. Capital expenses are incurred in one tax period and have benefits over multiple tax periods, like plant and machinery, like building. The pattern of allocation means depreciation, how these expenses will be used, how these assets will be used, how this basically capital item will be utilized over the period of time. So we can say the pattern of allocation of capital expenses may differ in the accounting standard and the UECT law. There are two possibilities basically. If you have bought plant and machinery for business purposes, there are two possibilities. First possibility is the pattern of allocation is same. Means accounting standards allow us to charge this plant and machinery over the period of 20 years. And the tax law say the same thing, 20 years. If the pattern of allocation is same, then in this situation, my accounting depreciation will be equal to my tax depreciation. If my accounting depreciation will be equal to my tax depreciation, so this accounting depreciation had already deducted to arrive at the accounting income. Means as from the financial, when we take the net profit from the financial statements, this accounting depreciation for sure it has already been deducted to arrive at the bottom line net profits. So there's no need to add back and deduct. Suppose my net profit is 100, accounting depreciation is 10. So principally this accounting depreciation needs to be added back and then tax depreciation needs to be deducted. The bottom line will be 100 because my accounting depreciation is same with my tax depreciation. This means the pattern of allocation is same. If the pattern of allocation is same, then no need to add back the accounting depreciation and deduct the tax depreciation because it will not have any impact on the taxable profits. Second possibility is the pattern of allocation is different. Pattern of allocation means this is a different, this is a second possibility. Means accounting says you need to depreciate the plant and machinery over the period of 20 years, but the tax says over the period of 10 years. So in this situation, when accounting standards requires us to depreciate the asset over the period of 20 years, but tax says over the period of 10 years, means in the tax world, my first 10-year depreciation will be higher and accounting depreciation will be lower. So I will be adding back, assuming the same example, 100 is my net profit from the financial statement. Accounting depreciation will be lower, assuming this will be 5. I will be add back 5, then I will deduct 10. Then at the end, my taxable profit will be 95. Means due to this lesser taxable profit, I will be paying lesser tax to the authorities. The reason is my tax depreciation is higher. Means tax depreciation is higher, I will be paying lesser tax to the authorities now, but in the future, I will be paying more tax to the authority. It will arise taxable temporary differences. We need to apply the provisions of the IAS International Accounting Standard 12. Deferred tax assets and deferred tax liabilities will arise in case the pattern of allocation of the assets is different as per the tax law and as per the as per the IFRS and as per the UECT law. But important thing is, it's important to discuss here. UECT law for the time being, this is silent about the word pattern of allocation of the capital item. But this is very clear. You cannot claim capital items in the same tax period because we have already gone through the provisions of Article 28(1). They said if the revenue, if the items are not capital in nature, you can claim in the same tax period. If the items are capital in nature, for sure we need to apply the provisions of this, that deferred tax assets and deferred tax liabilities will arise. This is what I believe, but we need to wait for the regulations for this. I hope everyone will be clear on this. So capital items, suppose the allocation pattern identical, we have discussed in detail. In case of different allocation pattern, we have discussed. If the allocation pattern is means the depreciation rate is different, depreciation here, depreciation rate different is same. If the depreciation rate is same, it will not have any, this item itself will not have any impact on the taxable profits. So if this is a different, for sure my taxable profit will be different due to accounting profit due to this item. Type of expenses. Now the Article 22, in the Article 28(2) of the UECT law that we said the expenses are not allowable for tax purposes. If the expenses do not pertain to the taxable personal business or relate to the exempt income of the business, these expenses are not allowed for tax purpose. Based on any personal and any non-business expenses or any other expenses specifically given in the UECT law, you will not be able to claim those expenses. Examples The expenses of B Limited has been taken in the financial statements of A Limited. There are two companies, one is a B Limited, one is a Limited. The expenses of the financial statement in the of B Limited has been taken in the financial statements of A Limited. While calculating taxable profits of A Limited, these expenses will be added back to the profits of A Limited. So A Limited profits are 100, but out of this, to arrive at this 100, some expenses of B Limited has been deducted, which would have not been deducted because these expenses doesn't pertain with the business of A Limited. So these expenses will be added back to arrive at the taxable profits of A Limited because it doesn't pertain to the business of A Limited. Losses not connected with or arising out of the taxable person's business are not allowed, and if already considered in the accounting profit, it will be added back to. So anything accounting profits of any company, if any expenses have been deducted to arrive at the accounting profit which were not allowed for tax purposes, these expenses will be added back to arrive at the taxable profits. Type of expenses: if the taxable person has incurred expenses for more than one purpose, we have already discussed. This is the clause number 3, 28(3) of the UECT law. 28(3) of the UECT law. Expenses incurred for more than one purpose. If we are incurring the expenses for more than one purpose, then these expenses will be apportioned on fair and reasonable basis, and it will be allowed accordingly. Suppose if X Limited and Y Limited are being managed from the same office, two companies, X Limited, Y Limited, these both are being managed from the same office. Then rent and other common expenses like electricity, telephone, internet will be shared between X Limited and Y Limited. None of the companies will be able to claim 100% expenses because these are the common expenses. What will be the basis to apportion these common expenses? We have just discussed basis should be fair and reasonable basis, but I believe these fair and reasonable basis will be given in the UECT regulations. There are some more expenses. Special provisions has been given in the UECT law for some expenses, like they have given the special provisions for the interest expenses. They have given the special provisions for the entertainment expenses. They have given complete list of the expenses which are not allowed for corporate tax purposes. We'll go through all these things one by one. So first of all is interest expenditures. Our next articles, our next webinar will be specifically on the interest. But in this article, in this webinar, we will take very high level overview of the interest. Interest basically, in the law, it has been given 30% of the EBITDA is allowed. Remaining portion can be carried forward for a period of 10 years. So this is the law. This is a very high level. This is a generic principle. They said you can claim 30% of the net interest expenses in this tax period. Remaining can be carried forward over the period of 10 years. So first of all, 30%. Second, EBITDA, earning before interest, tax, depreciation, and amortization. Third thing, this is a net interest. Net interest means interest income, interest expense. If in your financials, interest income is reflecting, interest expenses are reflecting, it will be netted out. After netting it out, we need to calculate the earning before interest, tax, depreciation, and amortization. While calculating this EBITDA, you don't need to consider the exempt income. You need to be ultra careful regarding this. So earning before interest, tax, and depreciation, you will take 30% of the EBITDA. EBITDA is assuming 100. You will take 30%. It will be 30. So interest expenses, you can claim maximum up to 30. If you are interest for the net interest, suppose interest income is 100, expense is 30, net interest is 70, but you can claim only 30. Remaining 40, it can be carried forward over the period of 10 years, but in our next webinar, in our next articles, we'll discuss the interest expenditures in detail. These are the generic principles. These general principles are not applicable specifically to the banks because this is the core business of the banks. They are receiving interest, they pay interest, so it will not be applicable on the banks. It will not be applicable on the insurance businesses. Some other regular financial services entities, interest capping rules will not apply to business carried by natural person individual. These provisions were given in These provisions were given in the UE tax assessment, basically, whatever the public consultation document, sorry. So in the regulation, it will give us more clarity, but in our next article, we will discuss in detail. For the time being, you can keep in mind, interest is allowed 30% net interest, 30% of net interest, 30% of EBITDA is allowed, net interest expenses remaining can be carried forward over the period of 10 years. Entertainment expenditure, Article 32 of the law says that claim only 50% of the entertainment expenses, amusement, recreation expenditure incurred during a tax period. So during a tax period, if any business is incurring entertainment expenditure, amusement expenditure, recreation expenditures, assuming the expenses are 100, it will be claimed only 50%. Remaining 50%, you will not be able to claim it. We'll just discuss in the example. These expenses include expenses for the meals, accommodation, transportation, admission fee, facilities, equipment used for entertainment, amusement, recreation purposes. These expenses may pertain to the taxable person's customer, might be pertains to the customer, might be pertain to shareholder, supplier, other business partners. If the company, if the taxable person is paying any expenses for the customer, shareholder, supplier, business partner, these expenses are of meals, accommodation, transportation, admission fee, facilities, equipment used for entertainment, amusement, and recreation purposes, then the generic principle is you can claim only 50% of these expenses, remaining 50% you can not claim. So while calculating the accounting profit, for sure the businesses will deduct these expenses 100%. 100 is my entertainment expenses, assuming the profit just before the entertainment expenses was 500, my entertainment expenses are 100, my accounting profit will be 400. This accounting profit needs to be converted into the taxable profit. When it will be converted into the taxable profit, so 400, out of this 50 is allowed and 50 is not allowed. So 50 will be added back. My taxable profit will be 450, accounting profit will be 400. So 50 is not allowable expenses. Just take this example, hotel accommodation has been provided to the taxable person, shareholder. This has been provided to the shareholder. We already discussed any expenses provided to the shareholder, customer, business partner. These will be called entertainment expenses, meals, accommodation, all these things, which cost 50,000 to the company. Along with the transportation and meal incurred cost 5,000 and 10,000 respectively. My total expenditures are 65,000. But I am allowed to claim only 50%. So 32,500 I can claim. Remaining 32,500 will not be allowed by FTA to claim as a deductible expense. Non-deductible expenses, this is the Article 33 of the law. This is a complete list of non-deductible expenses, the donation, grants, and gifts you cannot claim unless given to qualifying public benefit entity. We have already discussed this qualifying public benefit entity. There are some certain conditions. These are the exempt persons. These are working for the non-profit objective, but there are certain conditions related to this as well. If any donations, grants, or gift has been given to the qualifying public benefit entity, then you can claim. Otherwise, you can not claim. Fines and penalties unless paid for the compensation for damages or breach of contract, you can claim. Otherwise, fines and penalties you can not claim. Bribes and other illicit payments you can not claim. Dividend, profit distribution, and benefits paid to the owner, you can not claim. Dividend, profit distribution, or other benefits provided to the owner, you cannot claim. Law is silent about the salary. How much salary we can claim? Salary fall under the benefit? No, I didn't think so. It fall under the benefit. We need to wait for the regulations on this. Amount withdrawn for the business by a natural business person, it will not be allowable. Any amount withdrawn, it will fall under the drawings. They said this drawings will not be considered a deductible taxable expenses. Any corporate tax imposed, corporate tax will be applicable on the taxable profit after deducting all relevant expenses. So this corporate tax, they said it will not be a deductible expense. Recoverable input tax, you cannot claim, but the non-recoverable input tax is allowed. We all know this, that what are the non-recoverable VAT input tax? These are the basically pertaining to the some specific like car which can carry more than 10 or less than 10 people, which is available for personal use, we cannot claim expenses. We cannot claim for the dependent medical insurance unless these dependents are in Abu Dhabi. Up to 3 people we can claim having age less than 18, because this is a legal requirement in Abu Dhabi. Some other expenses which doesn't pertain to the business, we cannot claim input tax. If we cannot claim input tax, law says these will be your deductible expense for corporate tax purposes. Otherwise, any expense that you can claim, this will be your recoverable input tax. It will be your asset. It will not be your expense, because recoverable input tax is my current assets and non-recoverable input tax is my expense. So recoverable input tax is my asset. I will not be able to claim it. Non-recoverable input tax is my expense and law allows me to claim it. Tax imposed out of the UAE. If any tax is being imposed out of the UAE, authority says it will not be allowed for tax purposes and any other expense specified by the cabinet. So this is a complete list of non-deductible expense. We have already discussed the interest as well. We have already discussed the entertainment expenses as well. We have already discussed the expenses wholly and exclusively for business purposes. So coming back to the 3 conditions. So first, you can claim 100% allowable if these expenses are wholly and exclusively for business purposes. These are revenue items in nature. For the capital items we have discussed in detail, we need to wait for the regulation. Some expenses you cannot claim at all. We have discussed the complete list, and this complete list just would have donations, grants, fines, bribes, dividend, amount withdrawn, corporate tax imposed, non-recoverable input tax, tax imposed out of the UAE that you cannot claim. Other than this, 50% of the entertainment expenses you cannot claim. The interest will be carried forward. Only 30% you can claim. Remaining 70% will be carried forward over the period of 10 years. And other expenses we can claim. Common expenses we can claim proportionately. This is over from my side. I think we have discussed everything in detail. This is summary of the discussions. Entertainment, more than 50% we cannot claim. Losses not related to the business, we cannot claim. Related to the exempt income, we cannot claim. Losses not claim, more than 50% not claim. Non-business expenses, we cannot claim. Donation, grants, gift, we cannot claim unless given to the qualified public benefit entity. Fines and penalties, we cannot claim unless compensation or damages. Bribes and illicit payments, we cannot claim. Dividend, profit distribution, a benefit paid to the owner, we cannot claim. Amount withdrawn on the business by natural person, drawings, we cannot claim. Corporate tax imposed, we cannot claim. Recoverable input tax is with my assets, I cannot claim this. Any tax imposed out of the UAE, we cannot claim while calculating taxable profits. And all these expenses, if these have already been deducted while preparing the financial statements, it will be added back to arrive at the taxable profits. This is over from my side. We can quickly go to the frequently asked questions. These are questions have been taken from the ministry side. The first question is, what expenditure will be deductible for the purpose of calculating taxable income? We have already discussed 3 categories. 1 category cannot be claimed at all. 2nd category, common expenses will be claimed on proportionate basis. 3rd category, expenses wholly and exclusively incurred for business purposes. And these are revenue in nature. It can be claimed in the same tax period in which the expenses are incurred. So we can say in principle, they said legitimate business expenses incurred to derive taxable income will be deductible. You can go through this. I think this is the same thing, whatever we have already discussed. What expenditure will be non-deductible for purpose of calculating taxable income? We have just discussed complete list of non-deductible expenses. You can go through this. They mentioned which no deduction will be allowed, such as bribes, fines, penalties, expenditure incurred for deriving income that is exempt, not in connection with the arising of a taxable person business. You can go through all these in detail. Will my interest expenditure will be fully deductible? No, we have already set the general principle. 30% of EBITDA, EBITDA, earning before interest, tax, depreciation, amortization, you can claim. Remain 70%, it will be carry forward for the further period of 10 years, but this will not be applicable on banks, insurance companies, As I mentioned, in our next articles and next webinar, we will have a discussions on the interest. Might be the next article, might be the article just after this, because I am planning to have next article on the value added tax, which is recently public clarification introduced by the FTA, public clarification number 33, that deals that if the goods and services are being sold through the e-commerce platform, what will be their VATability, because this long pending public clarification which has been introduced by the FTA. I'm planning the next article, next webinar on the e-commerce public clarification. The article just after this, we will have a discussion on the interest, and we will have a more detailed discussion. What the reason why interest is allowed only 30%, we'll discuss in detail. Will dividend paid by the UE companies be deductible for corporate tax purposes? Not at all, because dividend will be paid out of the after-tax profits. It will be appropriation of profit. It will not be allowed for tax purposes. Will service fee paid to the local government to be deductible? Yes, this service fee is my common business expense. For sure, it will be allowed for tax authority, by the tax authority. Will value-added tax to be deductible for UECT purposes? VAT we have already discussed in detail. VAT can be two categories. It can be recoverable, non-recoverable. Recoverable portion is my current assets. These are not expense. I will claim from the FTA in the VAT return. Non-recoverable portion is my expense. Law allows me to claim while calculating the taxable profits. This is an introduction of our team. If you have any question, you can drop me an email. You can drop an email to Faiza, she's our tax director. You can drop into a tax manager, Maharanova. You can drop in Saqib Salim, he's also a tax person. You can drop an email to any of our team members. As usual, we listen, we understand, we delivered. If you have any question, you can come back to us, info@chriscooper.com. You can give us a call as well. Just one thing I wanted to tell you, that I have already shared the all past presentations in the PDF file. Just dropped an email in the morning today. I am pretty sure all of you have already received. If you have any question, for sure you can come back to us. Now going back to your question, first, common expenses can be allocated between related parties. It won't come under transfer pricing regulations. Yes, common expenses can be allocated between the related parties. Transfer pricing regulations will be applicable. We need to charge on arm's length basis. We need to be careful about this. If one party is incurring the expenses, that party is charging to other company, the other party, then for sure transfer pricing will be applicable. We need to apply cost plus certain percentage. Usha is asking second question, what about entertainment expenses for employees? Employees entertainment expenses for the employees. If any type of entertainment, it doesn't matter, they are given the basic different clauses as well. I believe if any entertainment is being provided to the employees, it will be allowed only 50%. Remaining will not be allowed unless and until we are getting further clarification in the regulations. Swaj is asking, when will reach the taxable income for corporate tax purpose? We will exclude 375,000, which will have 0% tax, and will tax the rest 9%. I know today grouping was not discussed, but when we will calculate groups, tax will be excluding will we exclude 375,000 number of entities in the tax group? So basically, I believe your question is, there will be 0% tax up to 375,000 taxable profits. Will it be applicable? It's the same provision on the group as well. Group is a one legal entity. It will be assumed one taxable person, the same threshold applicable with the group as well. It will not be applicable for individual entity wise. The same threshold, 375,000 will be applicable for the group as well. Up to 375,000, there will be 0% tax. Beyond this, it will be subject to tax at 9%. Swaj is asking one more question. Also, just to add, the interest do not exclude leasing interest cost. The interest doesn't exclude the leasing interest cost. Law is using the word net interest. Net interest means interest income and interest expenses. So we need to stick to the exact provisions of the law, net interest. And for further clarification, we need to wait for the regulations. Also, the entertainment paid to the employee, will it fall under the business partner? Because it is not mentioned. I believe, and as I discussed earlier as well, we should not claim these are the any entertainment provided to the employee. We should not claim 100%, and being on the safe side unless and until something specifically has been given in the regulations. Usha is asking, what about interest paid on loan from related party? As I mentioned, we will discuss in our next article in detail, in next webinar in detail, what is the reason that they are blocking this 70% interest. Their exceptions are, this is part of the exception. This we need to look into this in our next webinar. Abdul Samad is asking, sir, can you explain capital expenditure treatment? Capital expenditure treatment, whatever the example I have already given, it all based upon the global practices, but we need to wait for the regulations. But important thing is, for the capital expenditure treatment, if the pattern of allocation is same, accounting depreciation will be equal to the tax depreciation. It will not have any impact on the taxable profits. But if the pattern of allocation is different, accounting depreciation will be different, tax depreciation will be different. There are chances that they arise deferred tax assets and deferred tax liabilities. And we need to wait for regulations on this. Might be they are asking the accounting income can be treated as a tax, accounting depreciation can be treated as a tax depreciation, or might be it will be different because the current corporate law is silent. But this is very clear. They are asking only expenses which are revenue expenses in nature. It can be claimed 100% in the period in which these are incurred. They are asking capital expenditure will not be part of this. For sure, there will be certain specific regulations on the capital expenditure. We need to wait for the regulations on this. Hazib is asking, sir, what will be the treatment of rent paid in advance but not yet amortized monthly is parked in the prepaid expenses? Again, this is the same question. Might be it will arise a deferred tax liability, might be it will not. Principally, usually tax authorities follow cash basis of accounting, and IFRS follow accrual basis of accounting. The principal rules are different in two different jurisdictions. And if authorities are following cash basis of accounting, then whenever this rent is being paid in advance, tax authorities will allow 100%, but accounting will say to amortize it over the period of time. So in this situation, you will be paying lesser tax now in this current period due to you are claiming 100% rent expense, but in the future period, you will be paying more tax. So it will fall under a deferred tax liability. But again, we need to wait for the regulations. I cannot say anything conclusively on this because law is silent about this. So your all questions have been addressed, and the presentation has already been shared with you. So if you have anything else, you can drop us an email or you can give us a call, as I mentioned. Thank you very much again for being with us, and have a lovely day. Thank you. Thank you very much. Bye-bye.